Up next is Barnett Waddingham's Amanda Latham, Associate and Policy and Strategy Lead at Barnett Waddingham, here with me to discuss the ESG identity crisis. Amanda, hello. How are you?
I'm great. Thanks very much. Good afternoon.
Thank you. Well, thank you so much for joining us, Amanda. Amanda, if I could just start off, could you sort of tell us a little bit more about your role and what it is you do at Barnett Waddingham, please?
Yeah, absolutely. So I sit in our sustainable investment team, and I also work across the firm on sustainability. So that's both thinking about what's coming down the line in terms of sort of policy and regulatory agenda, so helping our clients respond to those things, and also in terms of thinking about our firm's sort of net zero commitments and other sort of standards and reporting commitments, things like the Stewardship Code, and our involvement with collaborative groups like the Net Zero Investment Consultants Initiative, and also the Investment Consultants Sustainability Working Group. So quite a lot of both internal and external work on sustainable investment.
Thank you. Thank you so much. Jumping straight into some questions, if I may. Starting off, how have you seen ESG investing evolve sort of over the past year or more?
So I think if we look back over, I'd say, the past couple of years, I think that sort of ESG 1.0 or sustainable and responsible investment, they were all sort of much more closely aligned, maybe in terms of how people are thinking about what those things represent, or maybe those terms are confusing to people and they don't necessarily differentiate between them. But I think if we think about ESG investing today, so maybe ESG 2.0, that's become a lot more linked with like a factor or a scoring based approach. So that sort of leads to a number of challenges thinking about ESG in particular, and where there's a difference of sort of inconsistency between ESG ratings agencies. So when we look at those things, we can see that methodologies are different. So that will naturally lead to differences in the ratings at the end of the day. For example, there's some analysis we've been looking at recently that suggests there's broadly 50 to 60% difference around measurement, and 30 to 35% is driven by what factors to include, and the rest is around the weighting that's attributed to each of those areas, right? Whatever they're looking at in terms of ESG. So against that backdrop, this lack of correlation isn't really surprising, but it basically highlights the complexity of the solutions that are out there and how we think about each element of environment, social and governance considerations. But the market's been developing, and the understanding of these things that's been developing along with it. So there's a growing acknowledgement that ESG investing is complex. And in our opinion, an approach that's based on scoring isn't going to be enough to address those complexities that are involved. So it's not about finding a single number to make a decision. It's about looking more broadly than that. But clients have been evolving their thinking, and so they're taking on board these more complex issues. So if we think about the recent gilt crisis, trustees understand the terminology used around hedging. They're more familiar with that. So ESG investing is probably going to develop along similar lines. People become more familiar with that as it has more longevity in the market.
Thanks so much, Amanda. To what extent do you think some of the challenges with ESG and sustainability undermine credibility? And likewise, is the same a little bit true when it comes when the whole issue becomes politicised as it has, for instance, in the US?
Look, I think that's a really important point. I don't think that the lack of consistency should undermine credibility, but it provides a reason for those that are reluctant to act, maybe to pause and to not take action. So if we think about the term ESG investing, that's probably been taken into a wider context, and in some geographies, like you mentioned, the US, it might be taken to mean climate, or more specifically, how you stand on the fossil fuel divestment debate. So I agree with you that term has become politicised. We've had a quote brought up with us recently where someone said, if you believe in ESG, you're a Democrat, for example. So there's definitely a political aspect to this in some areas. So we need to be really clear when we're talking to clients about the taxonomies we're using and the way that those things are portrayed. So ESG investing, it's about much more than compliance. It's a sort of broader, more complex area to think about, but there's definitely some political considerations in some areas.
Well, thanks for that, Amanda. Just looking at the compliance sort of issue again, and it's something that was raised earlier in this forum today. Does ESG ratings, TCFD, disclosure and regulation around SIPs, does all of this push ESG towards being viewed as that compliance issue by some, and more a compliance burden for trustee boards than a sort of force for good?
Well, that's certainly a risk, that because there are regulatory requirements around this, that it can be seen as a tick box compliance issue. But I think we'd see it as something much more important than that, or strategically important to how clients invest. So issues like climate change and the impacts that will have, things like biodiversity loss, these things are existential and systemic risks. So where clients are invested in diversified portfolios, they're not going to be able to diversify away from these systemic risks. That's sort of the thinking that's been going on for quite a while in terms of the green and sustainable finance sort of discussions that are going on. But these things, like the transition towards a low carbon economy, they also can create great investment opportunities. And then so capital flows into those over time can create a tailwind that can help investors. But we've seen throughout history that companies that do address societal challenges can be well rewarded. So there's certainly opportunity there as well. But if we think about how do we move from thinking about this as a compliance thing to something more strategic, I think we're seeing some clients are sort of implementing a TCFD framework. So I think if we think about TCFD, it's more than a disclosure, it's a governance and risk management framework is really the areas that should get the majority of focus, and a report's just the output at the end of the day. So we are seeing clients who are starting to embed the TCFD thinking and that kind of framework before that's becoming mandatory. And I think that's a helpful way to approach this, as that can give you more time to think about the governance structure and how you're going to manage that over time. Because I don't think this is the only thing to think about. We've got regulation around climate. We're expecting more regulation around biodiversity through the Task Force for Nature-related Financial Disclosures. And we've also got DWP's just kicked off a task force on social factors. So I think there's more sustainability considerations that will need to be brought in for trustees. So getting that governance right at the outset is probably going to be quite helpful, and moves you away from thinking about it purely in a compliance perspective.
Thanks so much, Amanda. Sort of moving on from that, what do you see as the driving force of behind ESG, and how does that reflect on its purpose, do you think?
So the driving force behind ESG, I think there's quite a lot of different drivers, and a lot of it does come from sort of broader policy agenda, but also sort of the evidence of what's happening in the real world. If we look at climate change as an example, we've had the IPCC reports talking about the trajectory the world's on, and trying to think about the risks and the tipping points that may be coming. Things like changes in land use, so land that's currently used for agriculture may no longer be usable, and areas might not be livable for people anymore, so that might cause massive population movements. So I think these things should be drivers for ESG considerations, certainly for investors, and particularly investors that have long-term liabilities. I think the way that we think about having an approach to sustainability is using ABC as a framework. So A is aiming to do no harm, and then to sort of thinking about the risks and thinking about how to manage and treat those risks. B is benefiting from the opportunities, as I mentioned before, the opportunities that emerge from these changes, and social changes as well as policy changes. And C is control the controllable. So have a really good governance framework in place and monitor the things that effectively can show you the outcomes that you're looking for. And then to use those things to frame your investment beliefs and your strategy as well going forward. I think alongside the drivers, there's also some challenges around ESG. I mean, a frustration with this is this sort of desire for accurate data and full data across the sort of full asset classes. I mean, that's not quite possible at the moment because we haven't got companies, and investee companies aren't yet reporting that information. So in effect, that kind of might be letting the perfect get in the way of the good and be another reason to sort of prevent action. And that can sort of create a barrier to this. But I think the key drivers for investors is thinking about these systemic risks, how they might impact over time, and the financial implications over different time horizons, and how you can respond today to start to mitigate the risks of, say, a 4-degree world and the damage and loss that will bring.
Amanda, you've mentioned sort of potentially one of your frustrations with ESG investing, that of data. What else is sort of frustrating you in ESG investing? Conversely, what's sort of exciting you when it comes to ESG at the moment?
Sure. I think one of the big frustrations is there's a lot of talk and maybe less action at this point in time. A lot of that, I think, will be people coming to terms with thinking about new risks and opportunities in the context, of their investment strategies, and also thinking about, the problems that are there don't necessarily match the actions that have been taken today. So I think there's a need for more action, certainly, and more consideration of how those things will impact and taking those things into account. Potentially holding sustainability to a higher bar than other risks that we consider when we're thinking about investment strategies is another area where there seems to be quite a lot of pushback in terms of maybe things that are more personal opinion and evidence-based in some places. I think that goes back to our discussion earlier about politicization. And then another area I think of frustration is the potential for greenwashing, or the emergence of greenwashing. We've seen a number of regulatory investigations from different jurisdictions. We've had investigations in the UK from like Advertising Standards Agency and other places. So these might be examples of like maybe not great governance in terms of the sort of public marketing of things that might not actually be bedded into strategy and being implemented. But this shouldn't be a barrier overall. I think the way that you can mitigate these kind of issues is by having effective due diligence on the managers that you engage to undertake the investment on your behalf, and making sure that their ideology, their beliefs, their philosophy aligns with that of the investor, and that they can credibly and competently carry out those investments on your behalf. So that's a way of sort of avoiding greenwashing, and then also some of the other issues I've outlined. In terms of what's exciting, I think it's the quality of people that are involved in sustainable investment, working across with we collaborate with other firms through Investment Consultant Sustainability Working Group, and they're just a really large group of really passionate individuals who are working both within their own firms, but also collaborating with others to try and really bring forward the agenda of sustainable investment. And also then the opportunities that sustainability and thinking about these complex issues can generate for investors.
Amanda, it might seem an obvious question, but is ESG therefore valid in your view for improving investments?
I think that's right, John. So I think that ESG can be very supportive for investment returns, and also there's innovation and creativity alongside that. So if we look back over history, that does suggest that companies that can facilitate changes like the coming energy transition or help to address biodiversity loss will be well rewarded. If we think about other transitions in the past, like I guess the move to like motorized transport is a really good one, and that you can see that companies in the past are incredibly successful in capitalizing on that transition, and the energy transition to low carbon is no different. And if we think about what's coming up, we've got the UN Biodiversity Conference, the COP15 coming up next week, so that should be able to give investors some ideas and inspiration in terms of the things that are needed and the things that can be financed into the future.
Thank you. How as an industry, if indeed you sort of believe that ESG does indeed have an identity crisis, how can we improve on this as an industry? What can we do to change that?
So I think clarity is really important. So if we don't keep conflating ESG and climate if we think about the links between environmental, social, and governance factors, and to be honest with you, all of those drive climate change risks and opportunities. So it's thinking about these things not in a siloed way, but recognizing the complexities between them, being clear on what it is that we're actually discussing. And I think if we start thinking, moving away from ESG, which I think we can all sort of see as investment jargon, and moving towards thinking about those individual considerations, what are the priorities for the trustee or the investor, and then thinking more about sustainable investment. So what does that mean going forwards? And I think there's a number of debates happening right now, but I think part of that is the impact that investments have on the environment and on sort of social outcomes, and then potentially starting to move into that space where you think about having a positive impact in those areas, and that might be necessary for portfolios to sort of achieve net zero over whatever time horizon they might set. So taking a really intentional approach when setting out your aims and beliefs in terms of your investment strategy, that can be really helpful for moving forward in this space.
Thank you. You talk about setting out investment beliefs, and if I can just sort of follow up on that one, if I may. Some trustee boards, particularly smaller ones, do struggle sort of setting out and clarifying their investment beliefs. Is there sort of any advice or any sort of pointers you could give them as to how they could clearly sort of set those out and come to a decision on what their beliefs actually are?
So I think this is a really important area. So, I mean, undertaking some training could potentially be useful, and thinking about those different sustainability considerations and how they might impact over the time horizons that the trustee had. So this can come into your sort of investment strategy review, or maybe if you're doing your implementation report, it can be part of what you're thinking about in terms of have our policies been effective over the year. Do those policies reflect what we're seeing in the market and what we think is going to be happening over time? And getting some, just increasing, I guess, the trustee board's competence in terms of and capabilities on sustainability, and also testing their advisors' competence as well. So just another plug for the ICSWG, but we produced competence guidelines for investment consultants that can help investors understand. It's focused at the moment on climate change, but it can help investors understand how capable and competent your advisors are as well, and so how you can sort of rely on their knowledge and expertise in helping you in this area. But I think it's asking those questions and getting to that understanding, and it's thinking about what is the sort of end game for the trustee, if that's a defined benefit pension scheme, if they're planning to exit the market or to undertake some sort of buyout transaction, at what point will that be, and how will insurers be considering sustainability and maybe building that into the trustees' considerations as well.
Amanda, earlier this morning, one of our panellists talked a little bit about sort of this weight of regulation that seems to be falling on trustees at the moment with regards to ESG. We heard from the FCA about sort of the weight of regulation that's coming down the line as well. It's easy, I think, for sort of trustees to get overwhelmed by this sort of deluge of regulation. To what extent do you think we should sort of, first and foremost be focusing on the outcomes, focusing just clearly on, what it is we want to achieve with sustainable investing, rather than getting too bogged down in all the regulation, aside that you actually have to comply with some of that, but
so I think that's a really good point to raise, and I think that you will be able to comply with the regulation and have an sort of effective and value-added governance approach to this. If you think about, like, for example, the regulations around the climate disclosures for pension trustees, those talk about the sort of the newer areas like scenario analysis, scenario modelling, in terms of as far as trustees are able. So maybe at this point in time, looking at the availability of data, if that's not particularly strong, which we know it's not in the market at the moment, but maybe that's not the area to focus on in the first round. We'd suggest much a stronger focus on getting that governance framework in place, and and identifying the risks and opportunities. Having a think about some scenarios, maybe doing that in a more narrative sense. So where a sort of quantitative modelling isn't going to tell you anything useful. It's not going to give you that decision useful information you're looking for. And looking at a sort of broader, more narrative approach to that scenario modelling. So, what we've been doing ourselves at BW is taking a sort of qualitative and quantitative approach with both sort of a top-down and a bottom-up view to help trustees to understand not what will the financial impacts of climate change be on those investments in 2050, because the data isn't there to do that in an effective way, but instead identifying the areas, the assets, the allocations that they have that might be at most risk or might have the most potential for opportunities in terms of the climate transition, to help trustees focus in their governance time, because we think that's something that can be really helpfully done today, but absolutely recognise there is a compliance burden and there's likely to be more areas in the future. I mean, we had in the first green finance strategy from the government, they talked about bringing in the task force for nature-related financial disclosures as soon as possible for all players in the investment chain. So I think we can assume that includes investors and asset owners. We have this task force on social factors. There's also a global task force on inequality-related financial disclosures. So I think we can expect things there as well. So I don't think these things are going away. And I think, just to plug again, the way I think to get away from that compliance burden is to focus in on the governance piece, which of course is very much trustee expertise is in governance and risk management, and then rely on your advisors in terms of those more technical areas like scenarios and monitoring and metrics, but sort of manage and monitor the things that can effectively show the outcomes that you're looking for, and take that approach to going through this. And so for smaller schemes, that certainly could be a way forward, is using a narrative approach to scenarios. While we can't financially model what massive population movements in a 4-degree world might look like, we can think about what those things might be like in a more sort of narrative sense, and we can understand that might have an impact on our investments over time, and we can think about what we can strategically do today. So I think that's one way of moving through these increasing requirements around sustainable investment and ESG considerations.
Thank you, Amanda. We're coming to the end of the time for our session. Thank you for taking so many questions. Last but not least, can I ask you for your key takeaways, including thoughts, please?
Yeah, absolutely. So I think what we'd say is to look to the horizon and not to the past when thinking about acting strategically in terms of your investment. So I think quite a frustrating comment that's been happening recently is, but I'll miss the rise in the oil price. And I guess the counter to that is, well, did you avoid the fall in oil price? Do you know how renewable energy pricing works? So think about what managers are doing and the extent that you believe in their approach and how that aligns with your own philosophy. So if, not all managers are the same, they do have different approaches to this, and some might be pursuing a low carbon approach, others might be looking to invest in the transition, and those will have different considerations. And I think the key to that is not to look back in 2 years and regret not taking any action today. So start to consider these things, start to build them into your strategic investments, into your investment strategy over time, and into your sort of strategic considerations. And I think that's the sort of key things to take away today.
Amanda, it's been really great speaking to you. Thank you so much for all your time today and for joining us at our ESG forum. Amanda Latham, thank you very much indeed. Thank you.
Thank you.